What's up, everybody, and welcome back to the Junior Markets YouTube page. If you're tuning in from YouTube, make sure to check out my website, Junior Markets. I go over a bunch of the stuff in this video in more detail. If you're tuning in from the website, this should be the video on the metrics page. And the goal of today's video is to put in all of the metrics that I put on the website into use. So you can see how we use these metrics to evaluate a real life company and how different metrics have different levels of importance with different sectors. So that's the goal for today. And today we're going to be using the company Tesla to do all of this, a company I'm sure you're all familiar with. So first off, to begin, on my website, I talk about a lot of turnover ratios, which are important for companies such as Costco and Walmart because you want to make sure that inventory is getting in and out and not going bad. So companies such as Sprouts, you don't want to see crazy inventory, crazy turnover ratios because you want that food getting in and out of your store and not going bad. So some of the ratios that I have on the website will not be applicable to this company. Some are sector specific. I'm going to be going over ones that are on my website because these are more common ones, and these are some of the basics that you need to have down before branching out into some more complicated ones. So first off, starting off with Tesla, we can see that today on the day of recording, it is up, but I'm pretty sure year to date it is down. Yeah, it's down 28%. So first off, we're only looking at metrics here. We're not looking at the business, macroeconomic factors, anything like that. We are purely just evaluating a company through metrics. So I am on the Charles Schwab website. I prefer this website as it is easy to navigate and gives me all the information I could ever need. So scrolling down here, the first thing that pops up is earnings, and publicly traded companies have to share their earnings every quarter. And as we can see, Tesla has missed earnings on the past 3 quarters, not by a lot, but they still have missed. And so some of the first metrics that we're going to start into here are the price to earnings and the forward PE. So a lot of people put a very heavy liking, I should say, in the price to earnings. People will just look at price to earnings when looking at a stock, and if it's super high, they may say, yeah, I'll pass, and then they move on. But one thing to think about with this is growth companies such as Tesla will have high price to earnings. So the PE ratio is the price divided by the earnings per share. So this is essentially how expensive a stock is relative to its earnings. So as we can see, Tesla's is 45, which is very high, but later on we're going to compare all of these metrics to other companies in the same industry, which is what you have to do when you're looking at metrics. You don't looking at them just one company doesn't mean a lot. You have to compare it to competitors. So Tesla would be looking at Ford, Rivian, other companies like that. So when you look at price to earnings, you also want to look at forward PE. So forward PE uses, instead of the current earnings, it uses forward earnings. So you always want to see a lower forward PE than the PE is now. And as you can see, it's about 25 points higher. So that's something we don't want to see. That means that the earnings aren't projected to be as good next quarter as this quarter. So now moving on down to peers and ratio comparisons. So one thing I like about Charles Schwab's website is they give you a bunch of competitors and the metrics lined up. So for this, it shows us Toyota, Honda, Ford, and Nissan. So let's get into these metrics. So I will only be going over metrics that I list on my website because as this is more of a beginner channel, these are the ones that you need to have down packed and are fairly universal. So first off, what it lists is the stock price, the 52-week range, the volumes, all that type of stuff. So as we can see, Tesla is a very popular stock. It far surpasses anything else in trading volume. So now let's move on down into return on assets and return on equity. So first off, for return on assets, this is a very important metric, And the higher the number, the more efficient a company is at turning an investment into income. So to put that more simply, a higher ROA, which is what it's called in the industry, means more asset efficiency. So as we can see, this is 13.58, and when looking at it against the peers, it is double the second highest. So this is very good return on assets. You want to see a higher number for this than your competitors. And then now moving on to return on equity. So return on equity measures the income earned for each dollar in stockholders' equity. So companies have to raise money. So then getting stockholders' equity such as common stock and preferred stock, putting that money in, this is how much the company gets out of that. So this relates net income to the investment made by the business. So the higher the ROE, the better a company is at converting its equity financing into profits. So as you can see, Tesla has a significantly higher ROE than any of these competitors. So with a higher ROA and ROE, you can see that Tesla is very good at turning financing and the money it's given into assets. So now moving on down, the first one we get to is earnings per share. And this is essentially how much money a company makes for each share of its stock. So you want a higher EPS. And discounting this outlier, we can see that Tesla is pretty in line with its competitors. And then moving on to, we already went over price to earnings and forecasted PE. So now we're going to go over price to sales. So for price to sales, this compares how much an investor is willing to pay for a stock compared to the company's revenues. So this is calculated by taking the share price and then dividing it by the revenue per share trailing 12 months, so for the past 12 months. And you normally want a PS below 1, as this shows strong share price performance, and anything above 1, the stock can be seen as expensive. But again, you need to compare it to its competitors, and if all of the competitors are in the same range, then it's not necessarily a bad sign. But as you can see, Ford's is very healthy, and Tesla has a very high price to sales. So this means that you might be paying more for the stock than the company is bringing in from revenue. So now let's move down into growth. So for all of these, you can look at growth this year, but it's more important to look at growth over time. You want to see consistent or exponential growth over the years, especially for a growth company such as Tesla. So that's what you need to look for there. And then moving on down, we get into gross profit margin and operating profit margin, as well as some other margins we're going to go over. So first, let's start off with gross profit margin, and this measures the income earned on each dollar of sales. So if a company has a profit margin of, for Tesla, it would be 17.78, then that means for every dollar of sales, 17.78 cents will go towards net income. So you want to see a profit margin above the industry level, and as we see, Tesla's is pretty even and in lines with everyone else. And then maintaining this profit margin or above industry level and increasing it over time can show that a company is lowering cost of goods sold and becoming more efficient in other areas. So now moving over into operating profit margin. Operating profit margin is the percent of revenue left after companies pay certain variable costs. So variable costs are things that change year over year, whereas fixed cost is a guaranteed set cost. So these include things such as wages, materials, because those prices are always changing. So you find this by doing operating income divided by net sales. And this means that the higher the margin, the better. And you want to see this increase over time. So this you want to see this, and this for Tesla, it's pretty in line with all of its competitors. So that's fine. but you really want to look at this over a scale, over a period of time, and see how Tesla is becoming more efficient. So moving on down into some ratios that are important for growth companies, we're going to hit on current ratio and quick ratio. So current ratio is the current assets over the current liabilities. So you want this number to be above 1. This means that there's more current assets than current liabilities. So that means in case of a struggle or something goes wrong, this company has enough assets to cover its liabilities. You can compare this to competitors, but it's just important to make sure that this company has enough assets to cover its liabilities. Now, quick ratio is essentially the same thing. You just take out total inventory from the total current assets in the numerator. And just like that, you want to see this above 1, which Tesla's is, so that's fine. Now, moving on into the last thing we're going to look at, which is long-term debt to equity, which can also be debt to equity. So debt to equity is industry specific, as you want your company to take on debt because companies have to take on debt to grow. So this means that, and to calculate this, you put total liabilities, which is current and long-term liabilities, in the numerator, and then you divide it by the stockholders' equity. And because the total liabilities are in the numerator, the higher this number, the more likely a company is to go bankrupt. So again, you need to compare this to other companies that are similar. So as we can see, Tesla's debt to equity is a lot lower than these other companies. Now, that can be seen as a turnoff because these other companies are taking on a lot more debt to grow, and that means that they could be growing at a significantly faster rate than Tesla, or Tesla is not bringing in the cash flow or the revenues to take on as much debt as some of these other companies. So again, you need to compare this to other companies in the same industry to decide if a high debt to equity or a low debt to equity is better for your company. So that is the end of this video, but I do have one more cool thing to share with you guys, so stay tuned for just a second. So I'm now in Excel, and this is the cool thing that I just learned. So if you type in the ticker for a company, and the company we just did was Tesla, and then you go into that ticker and click Alt A D 1 and then enter, and then you click the stock over here, you can get a bunch of metrics that we just went over, and you can get it all in one spot. So that's pretty cool. And then you can put them in Excel form, which I thought this was a pretty cool thing. Now, this is the real end of the video. Thank you so much for watching. And as always, check out Junior Markets, the website, as well as @Junior Markets on all of these platforms shown. And thank you so much for watching.